Hello everyone, you're very welcome back to the channel. Today, I want to talk about financial advisors. Specifically, I want to talk about the downsides of using a financial advisor to assist you in making personal investments. In other words, what are the downsides of paying a financial advisor to advise you on where you should invest your money? If you are thinking about using a financial advisor for investing, or if you're currently doing so, I would highly recommend that you watch this video to the end. I'm not going to be talking about using a financial advisor for getting a mortgage or insurance or indeed developing a financial plan. I'm only concerned with investments. What are the downsides of using a financial advisor in this area? First things first, let me clarify what I mean by the term financial advisor because it is quite broad and generic. A financial advisor can be someone who helps clients to develop a plan for achieving long-term financial goals, also known as a financial planner. It's typically accepted that all financial planners are financial advisors. However, not all financial advisors are financial planners. That's because a financial advisor can also be someone who manages investments on behalf of clients, or someone who acts as a middleman between the client and a financial institution which offers various financial products. That middleman is known as a broker. All of these functions technically fall under the financial advisory practice. In each of these cases, regulators who oversee the financial services sector will require the individuals who offer these services to have the necessary educational qualifications and practical experience. This is known as fitness and probity. Oftentimes, the educational qualification which is accepted by the regulator is the Qualified Financial Advisor certification. So, more often than not, any individual whose profession involves dealing with clients in respect of investments, insurance, loans, pensions, or financial planning will be a qualified financial advisor. With that being said, the focus of this video is going to be on the middleman, the broker. We're going to be talking about the downsides of using a broker to make personal investments. Downside number one, agency agreements. Remember, the function of a broker is to act as the middleman between you, the investor, and the financial institution who is offering the financial product that you'll be investing in. In plain terms, the broker is selling you the financial product that's offered by the financial institution. And because they're selling something, they're going to be receiving something in return, but more on that later. In order to sell financial products offered by a financial institution, brokers need to have what's known as an agency agreement with that financial institution. An agency agreement is effectively a document which permits the broker to sell the financial institution's products to its clients. Here's the issue. If a broker is only matching clients with financial products that are covered by the broker's agency agreements, then the investment options available to the client are going to be significantly limited. The client's options are restricted to the products that the broker is actively selling. What is the likelihood that the broker will happen to be selling the perfect investment option for you? For that to happen, not only would the broker have to have an agency agreement with the financial institution which offers the product, but the product itself would also have to be a product that is sold via the broker distribution network. I'll clarify what I mean by that later in the video. Long story short, if your broker only advises you to invest in products which are covered by its agency agreements, then your investment options are going to be restricted. Downside number two, commissions. Why would a broker limit themselves in what they can offer to their clients? Why are they using these agency agreements to sell specific financial products from specific financial institutions? Commissions. Brokers get paid a commission for selling a specific financial product to their clients. Commissions are a big point of contention when it comes to investments. Specifically, commissions which are paid at the point of investment into a financial product. Typically, a broker will earn commission on A, the money that you invest into the financial product, and B, the value of your investment at the end of each year. These are known as initial commissions and trail commissions respectively. Commissions are bad for investors. There's no two ways about it. The money needed to pay the broker their commissions has to come from somewhere, and more often than not, those commissions come at the expense of the investor's return. With initial commissions, a broker simply has to get you into a financial product and they get paid. With trail commissions, the broker gets to participate in the investment returns that the financial product generates for you every single year. When the product performs well, that's good news for you, but it's also good news for your broker because they'll get more money from trail commissions. When the product performs poorly, that's bad news for you, but your broker still collects their trail commission on the value of your investment. So the broker gets paid in both good times and bad. This brings us on to downside number 3, conflict of interest. The biggest problem with brokers who collect commissions from selling financial products is conflict of interest. Whenever there's an incentive for the broker to recommend one financial product over another, there will always be an inherent conflict of interest between what's best for the client and what's best for the broker's pocket. If a broker limits their client's investment selection to the products that the broker is paid to sell, then the broker has a conflict of interest. That includes having a bias towards recommending a product to a client where the broker stands to commercially gain from the client investing in that product. Earlier I mentioned that in order for a client to be recommended the perfect investment option via a broker, that the broker would not only need to have an agency agreement for that product, but the product itself would also have to be sold via the broker distribution network in the first place. Here's what I mean by that. If a broker earns money on the basis of commissions, why would they ever recommend a product that won't earn them a commission? Even if the product is in your best interest, why would the broker recommend it? Instead, they could offer a similar product that isn't necessarily in your best interest, but it's a suitable product and it's a product that will earn them a commission. Anyone who is versed on the legal obligations of brokers will know that I'm referring to the difference between suitable financial products and best interest financial products. Most brokers are required to recommend financial products that are suitable to their clients. Suitability is typically determined based on the needs and objectives of a client, as well as the client's attitude to and capacity for risk. The broker is required under law to carry out a suitability assessment before a product recommendation is made. This is the standard that regulators have deemed to be acceptable for brokers to conform to. For the most part, the suitability standard does a pretty decent job ensuring that a client doesn't end up invested in a product that is unsuitable to their personal circumstances. However, the issue with suitability, as I see it, is that it simply results in the broker determining which financial product in the broker's available selection is the most suitable to the client. It doesn't result in the broker recommending a product which is in the client's best interest. That product will always exist outside of the list of products that the broker gets paid to sell. Think about it logically. Do you really think that out of the hundreds of thousands of investment products that exist globally, your broker happens to be recommending the one product that's best for you? Of course not. This is why the best interest standard is more favorable for clients, and to explain why, I'll use a very simple example. Let's say a broker concludes that a client is best suited to a 100% investment in equities, i.e. stocks. The broker has an agency agreement with a financial institution who offers an actively managed US equity fund. So, because the equity fund is suitable for the client, the broker recommends that the client should invest their money in this fund. If they do so, the broker will receive a commission, and they'll continue to receive a commission so long as the client remains invested in the fund. That's the suitability standard. Now let's look at the best interest standard. Same scenario. A broker concludes that a client is best suited to a 100% investment in equities. The broker then starts to research equity mutual funds and equity exchange traded funds that might be suitable to the client. The broker decides that a passively managed index fund ETF is the best option for the client. The broker knows that passively managed funds tend to outperform actively managed funds over long periods of time. The broker also knows that passively managed ETFs tend to be cheaper than actively managed ETFs. The broker then assesses which index fund would be best for the client. He or she does this by comparing total expense ratios, tracked indices, fund structure, and dividend status. Finally, the broker arrives at the financial product that he or she will recommend to the client. With suitability, you'll end up in a suitable product, not the best product. And most importantly, you'll end up in a product that earns the broker commissions. With best interest, you'll end up in a product that is not only suitable, but when compared to other similar products, it's the product that will likely be in your best interest. That begs the question, are there brokers who operate the best interest model? Yes, there are, but I don't see them as brokers. I see them more as actual advisors. Brokers who earn commission are salespeople. Remove the commission commission and all of a sudden you're not selling anything. So how do you make money under the best interest model? You operate a fee-only system. These fees typically come in the form of either A, hourly rates or a flat fee that you pay the advisor, and or B, charging a percentage fee that's based on the value of your investment. Now I know what you're thinking. Dan, isn't the percentage fee the same thing as the trail commission? Yes, it is. However, the difference is that the fee is being charged on investments which have been made with your best interest in mind, not investments that the broker was paid to sell you in the first place. By virtue of making investments with your best interest in mind, your advisor has very likely saved you a lot of money in fees, and he or she has also very likely recommended a product that will perform better long term, though that's never guaranteed. Personally, if I was going to get advice on what to invest in, I'd want my advisor to consider all of the options, not just the options that stand to make the advisor money. If they do that and put my best interests forward, then I'm happy to pay that percentage fee. What's more, it's in the advisor's best interest to look out for your best interest, because they'll reap the rewards if they're successful. Don't make no mistake about it. Fee-only advisors are not without conflict of interest. Because their fee is largely based on that percentage of investments, it's in their best interest to ensure that you keep as much of your money invested for as long as possible. So a dodgy advisor may advise against selling even when it makes sense to do so. Also, watch out for any fee-only advisors who charge high hourly rates or flat fees. Many advisors will solely charge a percentage fee, which is the most favorable outcome, provided the percentage is reasonable. But what about the investment advisory practice as a whole? Does it have any real utility? Yes, using fee-only advisors will likely result in more favorable outcomes for investors. But is the fee-only advisor even required in the first place? I mention this because nowadays anyone can access the global markets using one of the many online brokerage platforms that are available. The de facto standard for these platforms is low cost or even zero cost investing. So here's a middleman, the online broker, who gives you access to the global financial markets and asks for nothing in return. No percentage charge on your investments and no initial commission on products that you buy using the platform. And if there is a commission, it's a fraction, and I mean the tiniest fraction of the initial commission that a traditional broker would receive. So we can fully rule out the idea that a traditional broker should receive a commission or fee for the simple act of connecting you, the client, with financial products. Online brokers have valued this function at nil. So we must be paying the broker for information, recommendations, and advice as it pertains to our investments. Therefore, logically, it only makes sense to use a broker if we feel that the information, recommendations, and advice that the broker provides will result in more favorable returns for us as investors than if we had invested on our own accord. There's two problems with this. Number one, it's been proven time and time again that investing professionals globally find it extremely difficult, if not impossible, to consistently beat the market over long periods of time, i.e. 20 to 30 years. If you didn't know, you could invest in the market right now using an online brokerage platform by investing in an index fund which tracks a stock market index that is representative of the market. You could do this at virtually zero cost other than the cost of the investment. The data shows that if you did this for 20 to 30 years, you'd be more successful than the investment professionals who try to provide their clients with a return that is better than the market. So if we can earn a return ourselves by utilizing a strategy that a monkey could execute, and that strategy has been proven to perform better than anything that the professionals can come up with, what exact investment information, recommendations, and advice can a broker provide that will result in more favorable outcomes for investors? Spoiler, in 99.9% of cases, there is none. So why are you paying for it? This applies to both commission-based and fee-only advisors. But the second problem, which applies to commission-based brokers and makes things a whole lot worse, is the conflict of interest. At least with fee-only advisors, you have a minute chance of receiving investment advice that could improve your performance over 20 to 30 years. But with commission-based brokers, any chance of that goes right out the window. How can a commission-based broker make a recommendation that has any chance of improving long-term investment performance when that recommendation is most likely going to be confined to the available selection of products that the broker sells. If the fee-only advisor can't do it with the whole market available, how will the commission-based broker do it with a limited selection? So once again, why are you paying for it? So here's my 2 cents on the utility of advisors for the making of investments. If you're young, you have many years of investing ahead of you, decades. The data shows that in those circumstances, the best way to build wealth over the course of those decades is through index fund investing, which does not require the assistance of a traditional broker. So provided you're a long-term investor, which to be frank is the only type of investor you can be, then I don't see a reason why you'd need to pay an advisor. But if you feel you need to, then use a fee-only advisor and state your desired intentions to that advisor. There is no utility in the commission-based broker for the long-term investor. Circumstances where the advisor has utility: financial planning, helping you to craft a financial plan that will allow you to hit your long-term goals. But remember, any investing activity that's part of that financial plan will need to be considered in the context of what we've discussed. If you're part of the small and wealthy subset of the population who want more from the short-term performance of their investments, specialized fee-only advisors can add value. But long story short, most investors with long time horizons will be best served using an online brokerage platform and sticking to index funds without the assistance of an advisor. What are my recommendations based on what we've discussed? Number 1, broker commissions should be outlawed. All advisors acting as investment intermediaries between their client and financial products should be compensated on a fee-only basis. This encourages advisors to find products that are not only suitable for the client, but also in the client's best interests. Yes, you could make the argument that brokers having to forego commissions would result in clients paying higher consultation fees, and in some cases it would. However, there's plenty of advisors out there right now who operate a fee-only model where the only fee in that model is a percentage charge of total investments, and in many cases the percentage charge is quite reasonable. So you'd simply avoid the advisors with the ludicrously high fees. Number 2, if broker commissions are to persist, then every broker who operates a commission-based model should be legally required to have an on-site calculator that shows the client the impact that those commissions have on their investment returns. Yes, brokers are required to disclose the commissions that they receive. However, you're living in fairy tale land if you think the average client is able to decipher the exact level of commissions that the broker will receive over the life of the investment. The commissions need to be totally transparent and quantifiable to the client. Number 3, if you are going to use a broker who receives commission for recommending certain financial products, here are some questions to pose. If I invest €1,000 upfront in this product that you're recommending and €500 every month thereafter for 20 years, A, how much commission will you receive? And B, how will those commissions impact my investment returns? I see you're recommending that I invest in this fund. Is there a comparable fund, be it a mutual fund or ETF, that would provide me with similar exposure to these assets at a lower cost? And by cost, I'm referring to the total expense ratio of the fund. What will I receive in return for the trail commission that you'll be collecting on the value of my investment in this product? Do I get ongoing consultations and advice? And if not, why? Do you believe that this product is in my best interest as an investor, or is it simply the most suitable product in your available selection? Do you believe I could get a better deal by investing in the likes of an exchange traded product using an online broker? You get the picture. I'd imagine that many commission-based brokers would actually tell you themselves that if you're going to be asking those kinds of questions, you're better off just using a fee-only advisor, and I'd be inclined to agree. Commission-based brokers profit off of consumers who don't have the financial literacy to ask those questions. So, in conclusion, commission-based brokers have very little utility when it comes to investments. The practice is rife with conflict of interest, and that conflict of interest goes against the best interests of the investor. If you feel like you need to use an advisor for investing, a fee-only advisor who charges a reasonable percentage fee based on asset value is likely your best bet. Advisors as a whole offer diminishing value to the average investor in the modern era. Online brokerage platforms which offer zero fee investing are empowering investors with the ability to access the global markets at no cost. Given that 99.9% of the population will be best served by investing consistently in low-cost passively managed index fund ETFs, it begs the question why an advisor is even required at all. We know that investment professionals can't outperform the market over long periods of time. So if we're not using advisors to beat the market, what are we using them for? You could say information, but we've already discussed the limited value of that information. Plus, with the advent of financial content online, like what you're watching right now, it's never been easier to access financial information and at no cost. Yes, you could argue that the reliability of that information varies greatly depending on who is delivering it, which is true. But provided you can find a creator who has educational qualifications and practical experience to back up what they're saying, their word is likely as valid as any broker. Remember, the broker has conflict of interest, especially if they earn a commission. The financial content creator might have little or no conflict of interest depending on the content. So through a combination of online content and personal research, you can easily manage your own investments without the hand-holding of a broker or advisor. Trust me, it's not difficult, and the more intermediaries you can cut out, the more money you'll save on fees. Just food for thought. I hope you found this video helpful. Let me know what your thoughts are on investment brokers and advisors. Would you ever consider using one? If you are currently using one, do you feel like your best interests are being looked after? Let me know in the comments. Thanks very much for watching, and I'll see you in the next one. Cheers.